Ladies and gentlemen, welcome. It's 6 o'clock in London, it's 1 p.m. in New York, it's 1 a.m. in Hong Kong, it's 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Good morning, good afternoon, good evening, depending on where you are in the world amongst our global viewership today. My name is Patrick L. Young. The IPO video livestream Series 3, Episode 3 begins now. So, since our last show, Brexit got done, despite what many others thought, and direct public offerings got a big nudge from the SEC. An excellent first step to making the initial public offering process modern and cost-effective, methinks. Chicago Board Options Exchange, CBOE, as they're known these days, completed their deal to buy the leading block trading facility, BIDS, which is great news. While over at TPICAP, their ritual suicidal desire to acquire Liquidnet once the doyen of block trading, which has since been deposed by BIDS, is now staring at a 2-for-5 rights issue. Given this is a bull market for financial market infrastructures, it's tough to see why TPICAP are reduced to refunding at distressed levels that would frankly embarrass the average shale miner. Oh, except, good point, this deal is a doozy. For lovers of pantomime season, the New York Stock Exchange led the way with a classic refrain of, "Oh yes we do, oh no we don't," albeit against the unique in the history of pantomime question of, are we listing Chinese equities? In a radical move, or is it just trying to cut down the National Stock Exchange poppy? A tall poppy which they themselves helped to grow. India's regulators, SEBI, are considering a new round of exchange creation. Proprietors can begin with 100% ownership, but are expected to reduce their holding over a 10-year period to a small minority. Presumably, if all else fails, TPICAP management can help with that dilution process. In People News, he may be asleep at this juncture. On the other hand, sometimes with the amount he produced, I'm not sure he ever slept, but let's salute Charles Lee. He left the CEO's office at Hong Kong Exchanges on December the 31st in an epic handover. For the moment, it's continuity. Calvin Tai, who's taken over as the interim CEO, he's one of the people in the running to take over from Charles as well. It has to be said, capacious boots, even though he may have had somewhat diminutive feet per se, because those boots, well, they managed to create such an incredible organization over the course of the last decade or so, surpassing even the somewhat becalmed CME behemoth to leave Hong Kong Exchanges as the largest single exchanges group in the world. Now, all this and more, ladies and gentlemen, has already been covered in greater detail in Exchange Invest Daily. That's the unique newsletter of the Bourse Business, where I, Patrick L. Young, supply the daily pith, just like this, except that I type it all out and put it in your mailbox. If you'd like to join the crew of people reading the newsletter, the only Bourse Business Daily Digest, send us an email or hit me up on social media, Patrick L. Young. Look us up via whatever stream you're watching this video on at this moment, and we can get you signed up to understand the exchange business better, pith included. Meanwhile, if you're enjoying this live stream, please, we don't condone violence in any political fashion, but could you do us a favor? Smash that like button, ladies and gentlemen. Give us a New Year's boost and help the search engine industry get away from all that negativity in the COVID sphere with some nice, positive, reasonable talks about, well, process, markets, growth, the economy. And indeed, on that point, ladies and gentlemen, our guest today, Mark Makepeace, is the man who made FTSE. He's the founding CEO of FTSE, originally standing for Financial Times Stock Exchange. It was a joint venture Mark's going to tell us about in a moment's time. It was a small UK startup back in the early dawn of modern indexing, way before even the true digital age, and he turned it into a global index provider. In fact, he arrived in the city of London at the point of the Big Bang in order to help coordinate things, and he just never left. Having stepped down as the FTSE CEO last year, Mark is a non-executive director of SGX, that's the stock exchange in Singapore, and much more besides, a very, very significant piece of financial market infrastructure, and also the home of the world's largest ever IPO. That was, of course, Saudi Aramco, none other than Saudi Arabia's Tadawul stock exchange, of which Mark also sits on the board. Mark Makepeace, it's lovely to see you. Good evening. Where in the world are you today?
Believe it or not, I'm in Tuscany at this time. I escaped London, and I'm enjoying some sunshine in Tuscany.
Good for you, Mark. That sounds like a fantastic place to be. And how are you finding the wonders of remote working from your Italian idyll?
The Italian way of life means that you have to stop every meeting for lunch and for dinner. But apart from that, it's been a very productive time.
Excellent. That's really good altogether. And ladies and gentlemen, in order to make this the most productive time we can have, we've got 1 hour with Mark until the top of the next hour. Why don't you hit us up with a little message or even a question for Mark about indexing, life, the index, and anything that you can possibly think of in the FTSE sphere and beyond. I'm sure Mark will be delighted to talk about it. So, Mark, you've just published, or at least in November 2020, it was published in the UK. It's coming out in the USA, I think, in March. Your first book, FTSE, The Inside Story. Well, it must have been quite a tale of daring do, because when you began this indexing thing, it didn't really look like it was going to be a slam dunk, did it?
No, it didn't. And I think there were a lot of doubters when we first launched FTSE. But this was back in '95, and there were just 9 of us sitting around the office trying to work out who would use us, what we could do. But we had a lot of ambition, and I think the more we spoke to the brokers, the bankers, and the fund managers, the more we could see demand for indices growing. But back in those days, indices were very simple, and the calculations were, by today's standard, very, very slow. I mean, the FTSE 100 was calculated once a minute, and everybody thought that was fast enough.
I can remember that well, actually, standing on the floor of both the options market at the LSE, the LTOM, and also in the futures pits in FTSE, or there or thereabouts, and watching things. And we were always trying to calculate where things might have gone. Was it a very busy minute, looking at the high beta stocks in order to see if they were going to be ticking the index up or down? As everything went, it was that lovely old, what was it, SGX screen or whatever they used to have, that they showed all the
51 on the topic terminal. That's right.
That was it.
Yeah.
Yes,
that was a big advance.
Yeah.
That was a big advance from the FT30. And the FT30, of course, pre-existed the FTSE 100. The FT30 was calculated every sort of 30 minutes when the prices could be collected off the floor of the exchange by the FT prices room. And there's a wonderful story we tell in the book where the stock market had crashed one day, and the FT30 was being published, and the index had moved, and a broker rang up the FT prices room to complain what was happening with this index. And of course, what they found out was one of the price reporters who was calculating the index, he had a dentist appointment that day. So it wasn't until he got back from the dentist that the index managed to catch up with the market.
Oh, that's absolutely brilliant, actually. It's great. It's really fascinating when you think about those sorts of things. I mean, and the FT All Share Index, I mean, which predated FTSE, I mean, that only got calculated basically at the end of the day, didn't it?
It did. But the real name, the FT Actuaries All Share, was designed to represent the whole market, and it was used really by the fund management community for their performance measure, and it was created by the actuaries, and the FT got involved in 1962 when the actuaries really just wanted the FT to publish the index on a daily basis, and it was calculated daily until FTSE took it over. And we then calculated it throughout the day once a minute. And I remember when we introduced that calculation, we were told by many in the market that it was not needed. Once a minute was, far too often for an index that was really only used for performance measurement. But times have changed. Times have changed.
Isn't technology wonderful? I mean, it's incredible. just how much the index world has managed to move on. So tell us a bit about it. You were 9 people in a room, small enterprise. Your first index was the FTSE 100, am I right?
That's right. And we had, before we set up FTSE, we had been collaborating at the stock exchange with the FT and the actuaries. So we had created the MidCap Index, the FTSE 250. And the story of the FTSE 250 was that when we created that index, we were following what was happening in the US market. US market being a much better market. There was a large number of stocks outside the 500 that were not being followed. So S&P introduced a mid-cap index. And we looked at the UK market. And at the time, the FTSE 100 represented large cap stocks, and the HKEX, smaller companies index, represented small cap stocks. And there was a gap between the top end of the HKEX and the bottom end of the FTSE 100. So we wanted to capture that area. So we introduced a mid-cap index, but we went around and spoke to 30 or so of the top or the largest fund managers in the UK. And they told us that there was no mid-cap effect in the UK. And there was only one fund manager who really supported us. But we were determined to do it to help promote that part of the market. We introduced the index, and in that, mid-cap stocks outperformed. I think because we had introduced the index, we had put a focus on that part of the market. And when we went back to that same 30 fund managers and asked them whether or not they recognized a mid-cap effect in the UK market, of course, the vast majority of them then told us they did. And in fact, half a dozen were running mid-cap funds. So maybe our market research wasn't quite up to the scratch it is today.
Fascinating, but it's interesting, like all of these things. I mean, looking back, 2020 hindsight can enable an incredible amount. Of course, soon after you were launched, then you launched the FTSE 100 index, and then you very quickly got into the derivatives business. I mean, you licensed to the stock exchange's own London traded options market for index options, and then you also created a parallel product with the then London International Financial Futures Exchange Live.
Well, Life and the options market were very much involved in the creation of the FTSE 100. In fact, the options market and the chairman of the options market at London Stock Exchange, he really led the initiative, or certainly was a big champion of the creation of the FTSE 100. And the 100 was created to support derivatives in the UK. So Life was quite actively involved. And it was Life who really pushed to have the FT involved. I mean, they, along with the FT, pushed the chairman of the London Stock Exchange at the time not to just create the index as a stock exchange index, but to have the index branded with the FT and published in the Financial Times. I don't think people realise, but when the FTSE 100 was first calculated and first published in January 1984, it was published as the SE 100. And it was only a couple of months later that it was published under its new name, the FTSE 100. And of course, the FT columnists branded it the FTSE, and that name just stuck. But I think it was the combination that really launched the success of the FTSE 100, because then it had instant recognition, and of course, the market got behind it to support the derivatives, and of course, the press and the media picked it up, and it never looked back from that time.
Fabulous story. And so during that genesis, what started as a stock exchange organization, effectively the FT also invested into it. Is that right?
That's right. That's right. And then because, of course, the FTSE 100 was introduced in '84, FTSE itself, the company, it took a number of years, but that was introduced in '95. And the whole thinking there was, if the stock exchange and the FT competed in this space, there just wasn't enough room in the UK. And really they needed to create an organisation that could compete globally. And that is why I sort of recommended to both the FT and the stock exchange, they should begin to collaborate. And we started cooperating several years before FTSE was set up. I think so relationships were good. And then we were able to sort of bring together the index assets that the FT had, which were international equities, and the share and their relationship with the actuaries, together with FTSE 100 and the calculating and technology that the London Stock Exchange had to really then create something that could be used not just in the UK, but that could begin to spread outside the UK and compete internationally. And the index market was still a very young market at that time, so there were plenty of opportunities for growth. But FTSE was up against two large American companies, one being S&P and the other one, of course, being MSCI. So we spent our time sort of competing and challenging with those two organisations. Although for a period of time, the S&P and FTSE were, we collaborated and we were partners in a global equity index until we the S&P. But so at times we were collaborating and at times we were competing.
And it's interesting because you say you were born into this sort of tripartite universe, particularly it was in those days, and you also had other companies like Russell, who undoubtedly we'll come back to in a moment. Yeah. And then there was the growth of the European index providers who came along to obviously challenge you as well, which was a whole new world, I suppose. By the time you'd find your feet, that was into the 1990s that they started to come along and also challenge the FTSE business.
And that's right. And I think when we started, we were the same size as the DAX team and the CAC team, and probably had as much chance as them of really growing internationally. And of course, in the early days, then along came the euro and the creation of stocks. So the early days were quite difficult. And I think it's only as we started to push into international equities and we grew our sort of international equity capability by sort of buying Barings Emerging Markets indices and combining that with the FT Global Equity Index. And bit by bit, we created a product that I think was stronger and better than MSCI at the time, because MSCI was quite a narrow index at that time. And we were able to then convince a number of very large sovereign wealth funds and large asset owners to adopt us and to use us. And we never looked back from that time.
Very, very interesting altogether. Now, ladies and gentlemen, we're 20 minutes into the show. This is the point in time when you should be hitting that like button with a frenzy as we're in this intriguing index discussion with Mark Makepeace, whose fabulous book, The Inside Story of the Birth and Development of a Global Index Titan, the FTSE Russell Group, is now in the stores most of the world around. FTSE The Inside Story. Also, you must have a question for him. We had a fabulous guest earlier in this canon of work. In fact, way back in Series 1 in Q3 of last year. A good, gosh, that was, I don't know, at least one Tesla refusal for the S&P 500, one acceptance, and a bit longer if you're dealing with it in index terms. Alex Maturi was an excellent guest from, well, he just retired at that point in time, hadn't he, from being the boss of the wondrous Dow Jones Indexes business. Ladies and gentlemen, send us your questions, please. We're talking to Mark Makepeace. He's discussing the growth in the world of indexing. And I suppose that leads us to, we've heard, Mark, about the idea of competition. We're looking at the whole way that markets have been developing gradually through the late 80s, the growth of the futures exchanges in Europe, which obviously Life was one of the first in. And as you say, there was the CAC index, there was the DAX index, and FTSE started to grow. You began very early in the piece by making acquisitions, as you mentioned, and I think those are things that people have completely forgotten. Actually, honestly, I'd forgotten you bought Baring's emerging market indexes as well. I don't remember that at all. Yeah. So how did you manage to grow the business through a mixture of generic growth and acquisitions? Because that's always very tricky.
Well, there were three parts. There was organic growth, where we were just growing our capabilities and building relationships with particularly the buy side, and then working with the banks in a sort of partnership way to get to their clients. So there was that organic growth. Then we sought partnerships. So we developed relationships with many stock exchanges around the world, and we developed indices for their domestic market, and that grew our sort of client base and reach in those countries. And then we could sell our international products to those same clients. So we worked with the Johannesburg Stock Exchange, the Athens Stock Exchange. We worked with Singapore. We worked with all the ASEAN exchanges. So we increasingly worked with exchanges, and that helped us build a sort of an international footprint. And then that last point is we acquired from banks, we acquired from other sort of data providers, so that we could extend the product. And of course, the biggest acquisition was the Russell indices, and that was a huge acquisition. And there we were competing with particularly MSCI, S&P, as well as other fund managers in trying to acquire Russell. But it went down to a final three, and it was sort of Henry and MSCI against myself, FTSE and the London Stock Exchange, and a fund manager. So it was competitive in winning that business, but that again was a huge win for FTSE. But there were other acquisitions throughout. We acquired the bond indices in Canada. We also more recently bought Yield Book and the City Global Bond Indices. So we've constantly, as we've grown and had capabilities, we've added to that through acquisitions. And it's been that combination that really allowed FTSE to grow to a size where, when I stepped down, we had just over $16 trillion that were following FTSE that could be identified. So probably much more. But $16 trillion was influenced by the decisions we made.
Good grief. Ladies and gentlemen, we're listening to a man who had $16 trillion following his team's every word, or at least every data interaction. I'm surprised, actually, Mark, you're not sitting there with a very large, long-haired white cat gently stroking it in your Tuscan lair at the moment. I mean, that's a serious number, actually, 16 trillion. As you say, that's only addressable. You're not even talking about the people who were effectively following in some way, shape, or form that weren't coming through on your direct statistics. That's serious numbers, intriguing. Fascinating to hear about the Russell thing, which we'll come back to in a minute. But actually, we've got a question which is very interesting from an audience member. Thank you very much. And the question is asking, about the downsides of creating those sorts of things. I mean, what indices didn't work out as you had hoped?
There were many indices that we thought would be a success that weren't. I mean, I suppose in the early days, we tried putting competitors to stocks, and we failed there. We worked with Euronext. We also, before the euro was introduced, we worked with Goldman Sachs to introduce what was, those with good memories will remember as the Eurotrack 100. Which fitted with the way the UK fund managers manage Europe, which was a sort of Europe ex-UK. Because we thought that would align together with their existing UK holdings, so that together they would have a pan-European approach without having to adjust their UK benchmarks. But of course, it just didn't take off. And so sometimes you think and you work hard and you involve a lot of clients in the discussion, and you all arrive at a consensus, but it somehow just doesn't work.
Well, it's a great point. Yeah, I mean, it's a great point because, I mean, I think it's interesting not because the products don't fail because they're fundamentally badly designed. I mean, simply they weren't the right thing at the right time. And Eurotrack, I thought, was fascinating. I was there on the floor of life, actually. I remember it very well. And we've got a question coming up in just a minute from Jonathan Seymour, who was, I think, at life at the time. He's probably face palming. Oh my God, what are you talking about this for, Patrick? Please. But it was really interesting because there was no failure on the part of life. There was no failure on the part of FTSE. It was simply that there wasn't a big enough kernel of people waking up in the morning thinking, what's Europe going to do today? There was no consciousness of that. And what's weird is, when was that? 1996 or something? Something like that.
That's right, in that sort of time. But it was actually, and I think the euro, and I think the one thing which stocks really did get right was they focused on the Eurozone and just that group of Euro stocks. And that really took off. And I think it was just too early to try and do something that was pan-Europe or that went beyond that Europe group of stocks. And talking to all the fund managers wasn't what the fund managers were telling us, but that's what turned out to be the case.
No, I think it's true. And we got a great comment there. Thank you, Jonathan. Good evening. It's lovely to hear from you. Don't mention the Eurotop, the Eurostars, or the Euro First. It's true, though, because I think actually I was being ambitious. I suspect Eurotrack is actually about 1992, something like that. It's actually quite a bit earlier now I come to think about it. But it was, a very good idea. But I just don't think that the consciousness was there. That wasn't how the business worked, actually. I mean, 90%, it's incredible. You look at this, you look at the last 2 weeks where everybody's predicting the death of the City of London because they can't directly trade European stocks in London. And yet you look at the time that the Eurotrack was launched and absolutely nobody traded European stocks directly in London, or at least certainly they didn't trade them to enough of a degree to make the Eurotrack actually fungible or functional. So it's fascinating how time moved on that whole thing, and the Euro and MiFID and so on also developed it. But that brings us neatly to a great question from Jonathan Seymour. Good evening once again, Jonathan. It's lovely to hear from you. So, Mark, how did integration into the London Stock Exchange Group help or hinder the FTSE business? And I suppose there's two waves of integration, because one is you were born in the group, and then subsequently one of the early deals of Xavier Rollet, which I have to say I thought was utterly inspired, was to buy the other half from the FT at a time when, frankly, index businesses weren't as hot a property as they would be today.
Oh, and that's right. And you've got to give Xavier credit because he paid, at the time, a high price for the other half of FTSE. And FTSE was a very independent company at that time. And if anything, was more influenced by the FT than the exchange. So it was a brave decision by Xavier. And Xavier and the board sort of they encouraged me to stay. I think any integration when you're coming from outside is always difficult. But what the exchange gave us is they gave us the capital to make bigger acquisitions. And they also gave us the sort of capital and the credibility that went beyond what FTSE was at that time. So soon after we were acquired by the London Stock Exchange, or the other half was acquired. We did, of course, the deal with Vanguard, where with Vanguard, they moved all of their international equity benchmarks away from MSCI to FTSE. Now, we have been talking to Vanguard about that prior to the London Stock Exchange taking over FTSE, but that actually, in many ways, helped because it gave them more confidence. We were part of a big organisation, and they welcomed that. But then it gave us the opportunity. We could not have acquired Russell if we had not been part of the London Stock Exchange Group. So it gave us much bigger sort of firepower. But any integration and bringing together different cultures is all cool. And I've got to give credit to Xavier, who he worked hard to make that happen, and he promoted me and put me in charge of the information services at the London Stock Exchange. So I then brought those things together. So it's not an easy thing, but I think with the right leadership, you can overcome what are always sort of difficult integration issues. But I have to say that London Stock Exchange was enormously helpful to FTSE's success at that time.
Very interesting, and I think you make a very good point, and I agree with you, because at the time there were very few people who really thought LSE paying what seemed then to be a high price for the FT side of the FTSE business was a good move. I was one of the people who thought it was a brilliant idea. Actually, I thought it was absolutely inspired, and particularly the energy that Xavier brought to your side of the business was great, because it allowed you to go forward and do the Russell deal and so on. Tell us a little bit about that Vanguard deal. I'm sorry, thank you very much, Jonathan. I love the question. It's great to have you engaging as ever this evening. Great to hear from you. Tell us a little bit more about that Vanguard deal. I mean, that sounds quite fascinating, because you literally took a huge swathe of international benchmarking business straight out of the mouth of MSCI. I mean, it's not that common that you see so many things moving to that degree.
No, but we were competing with MSCI, and I think as we were having some success with some large sort of sovereign wealth funds who wanted a more customized version of the global benchmark, and we were sort of willing, because we were much smaller. We were willing to do the extra things that MSCI probably was less willing to do at the time. So we had grown some reasonable amounts of business, but for Vanguard to sort of trust us, that took a number of years, and the seeds of it were really when MSCI licensed BlackRock to create a sort of an all-world version. So in other words, bringing together developed and emerging together as an ETF. And Vanguard was looking around because it wanted to do the same thing that MSCI had licensed BlackRock. So MSCI wasn't available. So I made the offer to Vanguard that we would provide them with that benchmark, and we would do it at a very low cost, which would enable them to compete aggressively on price. Mm-hmm. And of course, that fitted with what Vanguard was trying to do. They tried that. Vanguard went with us at a lower price. BlackRock went with MSCI at a higher price for investors. And of course, everyone knows what happened is that the investors chose Vanguard product, rather than the BlackRock MSCI product. And I think that gave Vanguard the confidence then to start to say, look, we could move the rest of our sort of international products and reduce the price for our investors. And that was then sort of, that thought was put in train. And it took us a couple of years to get there, because we had to prove that we were capable of doing what Vanguard needed us to do. But I think once the seed was planted, then it was really just all about how could we over the next couple of years achieve that. And of course, when it happened, it was a shock to the market, because the market hadn't have kept up with the fact that we were competing with MSCI. So of course, on the day, MSCI learned just the weekend before the announcement, and of course they had a press release, and as they were talking to the press, the share price was collapsing, because at that time nobody thought that MSCI could be challenged, and their share price at one stage was down 30%. Now, clearly, it's grown and been incredibly successful, and I think Henry and his whole team have done a superb job. But that was a real time of change.
Fascinating. The real-time challenge of indexing, ladies and gentlemen. We're here with Mark Makepeace. He used to be the boss of FTSE. He was the founding CEO, the man who turned it into the FTSE Russell powerhouse under the London Stock Exchanges Group's management. We've enjoyed a great interaction. Do remember to hit that like button. Thank you very much in advance for any likes you may offer us on social media. And do please drop us a question. We'll be delighted to discuss further. Thanks to Jonathan Seymour for those interesting questions earlier, amongst others. So Mark, when you were going and globalizing this business, I'm sure it was fascinating because you did an incredible amount of traveling. Traveling, if anybody's forgotten, was a thing where people used to go and get business by going and getting into aircraft, and they go around the world and stay in hotels and meet people, as opposed to just having Zoom calls with them. That's for anybody who doesn't remember the way that the world used to look all those many years ago before we became a windswept COVID wilderness. Well, you were out there, you were traveling the world, Mark. Tell us, I mean, what was it like? I mean, you were very early into China, as I seem to recall.
We did. Look, my job became one of networking and trying to find those next big opportunities. And I was convinced that China would open up and that China would be such a huge market. But I think we were a little bit ahead of our time. I was introduced in Hong Kong, in the Captain's Bar, for those of you who know Hong Kong and the Mandarin Oriental in Hong Kong. And I was introduced to a lady called Freddie Bush. And Freddie Bush had secured a license from the Xinhua news agency to run indices in China. And at that time, no international index provider could run indices in China. And that led to us going in, having a partnership with the Xinhua news agency, which of course was a very difficult sell to the Financial Times. But we went in, we had a partnership with the Xinhua news agency, and we began to become the benchmark in mainland China. We had the ex-chairman of the CSRC who chaired our advisory group, and as the institutional side of that market was starting to grow, we had strong usage across the whole of China, and widespread publicity through all the media channels there. So we went to have an incredible position in China within a few years due to the backing of the Xinhua news agency. But we then got challenged by Shanghai. And it was at a time when the modernizers amongst the CSRC were leaning in one direction, which was encouraging us, and some of the others were sort of leaning other direction, where they were concerned about the market and the way the Chinese market was developing. And we were encouraged by part of the government, but we obviously knew that opinions and consensus was being built in China. Now we created the China A50, the FTSE Xinhua A50, which became the largest ETF on A shares trading in Hong Kong. And of course, I think at that stage, I think some of the Chinese authorities started to think they needed to develop the internal market in China more. And of course, we then licensed Singapore to trade futures on the A50. And initially they didn't take off, but then when the SGX changed contract size, then those contracts started to take off, and they still trade incredibly active today. I think they're the largest contract on SGX. So we were starting to have success, but of course, with success brought us attention, and we did go through a period where I was taken through the courts of Shanghai to try and restrict our access of China. And that happened for a couple of years before we could finally find our way back into China. So I think going into China when we did in 2001, I think it was at a very early stage, but of course it built the sort of relationships which allowed us to really have talks and help the Chinese as they sort of entered the global benchmarks. And it's only recently that they have entered the global benchmarks. But a lot of that was because of work we undertook in the early 2000s to really sort of build the relationships and grow their understanding of what they needed to do so that they could get access to those international investors. And I do think China as a market will continue to open up. I know there are sometimes geopolitical issues, but I think China will continue to open up. They will continue to become a bigger and bigger part of global equity portfolios. And I think investors in the next 5 to 7 years will really be looking at a global portfolio that is made up of something like 65 to 70%, which will be the US and China. So China will become a big important market that they will have to follow.
Fascinating. So 65 to 75% you're estimating that's going to be
my prediction in the future. When China is fully included in global benchmarks and China is open, because the size of that market is much bigger than people think, and the number of IPOs which have yet to come to market, are backed up in that market. So it is a sizable and important market.
Yeah. Oh, no, I think it's very interesting. So you're reckoning that could be in X years' time, and obviously we can't say exactly how many years, but at the same time we know that, well, President Xi today was outlining the 30-year view for the Chinese economy and the Chinese government per se, which is a nice piece of long-termism for the rest of us all living quarter to quarter. So here you're talking 65, 75%. Then what about things like active versus passive? And actually, before you go there, I want to ask one quick question, because we have an excellent viewer question that has just come in. It's about ETFs. One thing we haven't mentioned, well, you mentioned it briefly on the way through, but I mean, we used to have mutual funds, unit trusts, investment trusts, and those were sources of indexing interest. How much did the ETF, the exchange traded fund, change the index business? Asks one of our viewers.
I think ETFs changed the market hugely. Suddenly you had these products which meant that you could create indices, thousands and thousands of indices on themes, sectors, smart beta. Suddenly you just had every fund manager wanting to create a specialist index on which they could run an ETF. And so that really then became a massive market for the index providers. And of course that income gave them the ability to fund investment in their businesses. So their businesses started to employ quant research, leading analysts from the market, and suddenly the index providers built the skill sets that they didn't have before, and that only really existed in the banks and the fund managers. And then you found ex-fund managers, ex-star analysts working for the index providers. So it completely changed the index business and allowed index companies, certainly the big three, to become companies which could create a level of product that before could only be created by banks and fund managers.
Fascinating altogether. And just therefore give us a little bit of colour. You started with, what, 9 people in the mid-1980s. Now, before you did the Russell deal, what was the FTSE headcount up to roughly by then?
We went above 1,000 staff, and they were still growing. But the quality of the staff also improved. As I said, you had PhDs, you had quant. I mean, at one stage, I think I used to say we had the biggest quant team in London. So it became very impressive. And I can see a good friend, Alex Maturi. And
Alex Maturi. Exactly. Alex Maturi, congratulations, by the way, Alex Maturi, on your appointment to the board of SIBO. I think that's fantastic news. And it was fabulous to have you as a guest on IPO VID just a few months back. Great to see you once again and interacting, saying hello to your old friend, Mark Makepeace, the former boss of S&P Dow Jones, or Dow Jones Indexes, is talking to the former boss of FTSE, Mark.
But Alex and I, along with Henry, set up the Index Association.
Yes.
And that's because we reached a point where we thought, the industry needed to sort of raise standards and needed a voice, and actually Alex was the one who put the suggestion to Henry and myself, and we were fierce competitors. So to have someone, have the foresight to do that, I give him, a lot of credit for doing that. And it was absolutely the right thing to do, and to make sure it was open to all index providers, and to really help raise standards and educate regulators and help educate the market. So I think, I look back and I'm very proud that the index industry, it went through huge growth. It didn't do everything right, but it actually tried. We tried to create the right environment for these products.
I think it's a great point, actually. Yeah, and the Index Association, which is running out of New York at the moment. Am I right in thinking? Is it Rick Redding runs it? Is that right? No, who's Rick Redding? Good stuff altogether. Well, we've got two very interesting questions, which I'm going to actually elide and then give you a chance to answer them to your leisure, because they're pretty huge. First of all, Agata Bellon, it's lovely to hear from you again, Agata. Dobry wieczór. What are the opportunities in indexing? She wants to ask. Now, park that for a second, because we've got another sensational question that's coming on. No, actually, I'm going to let you answer that question first of all. What are the opportunities in indexing at the macro? And we're going to get on to some more specifics in a moment. Mark, please.
There are so many opportunities at the moment, but let's start. On indexation, it's still mainly in equities. So it hasn't really spread yet. It's starting to spread into the bonds and credit markets, but it's got a long way to go. So it's got a long way in spreading into other asset classes. And in equities, indexation, passive management is still only something like 25% globally. So active is 75%. Over the next decade, that will flip. You can already see that from investment flows going into low-cost indexing. But I think you will see that flip. So there will be much, much greater opportunities just in indexing in equities alone. But you'll also see themes such as ESG is a huge opportunity. And I think you'll find people will go on to sort of think about how they use technology. And at the moment, the way indices are created is that the index provider is at the center, if you like, of the network, creating products and pushing them out. Whereas technology changes that dynamics. I think in the future, the index providers will be providing the sort of data and the building blocks, and the technology will allow the end users to create a wide range of indices going across asset classes. So I do think there's huge opportunity, there's huge change that will come into the index market. And I think it's a very exciting time. And it will be really, really interesting, watching and helping and advising people as they go through these changes.
Absolutely fascinating. I'm going to ask you one quick question before we get to the superb question that we've got from Peter Elwin. Thank you very much for that. We're coming to you in just a moment, Peter. You mentioned a couple of times cost. You mentioned cost in the Vanguard Deal. You mentioned cost in the whole new era of potentially semi-decentralizing, for want of a better buzzword, the whole business of the index business. How much do you think the issue of cost is really going to play a role in the future of index development?
Absolutely. The indexation is about two things: greater transparency. So in other words, when we had smart beta, the reason why indexing really took off in that space is because suddenly you had the transparency of the investment strategy you were following. So you had transparency, whereas before you were dependent on, the choices of the fund manager. So you didn't have that transparency. And the other one is low cost. And even if you look at those investment flows, the vast majority of the investment flows into index funds still go into the low cost funds. So I think it's that combination, low cost, high transparency, is the real secret to indexation. Because they can replicate any investment strategy, then, and if you put the tools of which strategy you want to use and how you want to mix them within your portfolio, it becomes very, very powerful. And it reduces the cost of investment for institutional investors, and it will go forward for retail investors, and it should help them make much more informed decisions and therefore help them manage the level of risk that they want to take.
I think that's fascinating. It's really, really interesting. I remember writing, when I wrote Capital Market Revolution in 1998, it was published in 1999. That was one of the things that was so epic, because I made this suggestion that exchange traded funds, they barely even been called exchange traded funds at those point in time. The index linked tracker fund, I think I was calling them, they were going to be a huge thing because they were going to use that index product and produce a lower cost. And I remember a lot of very elegant bottles of claret being emptied down my throat while people were essentially threatening me in a very bourgeois fashion because their 500 basis point fund load was sacrosanct. And yet that was one of the quick casualties of indexing in the digital age. And so interesting how that's all changed. So ladies and gentlemen, we're in the last 10 minutes at the moment. We are talking to Mark Makepeace, the second index guru we've had on the live stream series of IPO over the course of the last few months. Alex Maturi, the first of all. The first guest we had in the indexing world checked in just a few minutes ago. We're with Mark. We're adding, I think, certainly at this point in time, Smart Alpha rather than looking at Smart Beta, which has obviously been one of the products that was absolutely vital to the growth of the index business. So we have two epic questions that have come in. I'm going to give you the first one, which came from Peter Elwin. What do you feel, Mark, about the surge in single and multi-family offices and the great wealth transfer, to the next generation inheritors, particularly the next generation's interest in social impact investments, ESG, and technology?
I think this is certainly the big trend. ESG, when private wealth managers survey their clients and then they survey the children of those parents, they get some different answers. And the most important difference is that the next generation really value the ESG, the environmental, social and governance. And that will become the standard way of thinking about products in the future and managing products. So I do think that ESG in the next generation will be wanting to make sure that the funds that they're choosing and the ETFs they're choosing, they can understand the impact from an ESG point of view. And I think what's been happening in the last few years is climate change and the environmental side has had a lot of following. But the social side is still very much sort of underdeveloped. And COVID is really, I think, beginning to challenge some of that area. So I think you'll see a growth in diversity and a whole range of social thinking and social product. And of course, the technology part of this is everybody's now getting used to using technology in a way that has changed their life and will continue to change their life. And technology will give us capabilities that mean, I talked before, the index providers do not have to calculate the indices, and the choices they make can be moved with technology out to the end investor and give them the choice. So I think ESG and technology and the combination of that will just mean much greater choice for for those end investors. Now, the challenge there is how do you help educate them so that they make good choices for them, and how do you provide the governance so that the information they're taking in to make those good choices. So I think brand will become even more important, because the brand has to be a trusted brand, and I think therefore we're going to see, I would have said, a number of players who will grow in this market, who have very strong trusted brands, who can educate the retail investor base as well as the institutional base, but have the capability to really provide ESG in an insightful way. Because the first stage of ESG was about ticking boxes. Now it's about insight. And I think those things are completely different.
It's fascinating, really, really interesting. I agree with you totally, and I think the social impact issue is quite key. We've done some work in that in the recent past. It's very interesting how generational differences are there. But tell us, how did you get into the ESG business in the first place? Because I believe there's a great story in your book, FTSE the Inside Story, about this, where you met, well, a true global figure.
I did. I met a true global figure, and there was branding, there was cigars involved. I do work for UNICEF, and one of the UNICEF ambassadors was Roger Moore, 007. And Roger spoke at an event I hosted to fund managers and hedge funds, and I think it was in Geneva. And afterwards, Roger was enjoying a brandy and a cigar, and we were sort of alone. I think there was just one or two people left with us in this hall. And Roger challenged me. Roger said to me, he said, "Mark, you need to create an index of just the good companies and then give that money to UNICEF to do good." And that was his challenge. And at the time, I think I'd had enough branding to think that was a really, really good idea. And so we set about trying to understand, what was a good company. And I think that's what got us into ESG, and it led to the launch of FTSE for Good. And it was Roger Moore's creation. And therefore, when we launched FTSE for Good, Roger came to London and helped me launch it. And there is a wonderful picture that the FT published on its front page, with Roger and I laughing at one of his jokes outside the London Stock Exchange. So very fond memories of Roger, but Roger was the one who really came up with the idea of FTSE for Good and challenged us to take on that and do some good and give the money to UNICEF.
What a super story. And of course, you can read many, many more in your excellent new book, FTSE the Inside Story, which is out now. It's coming to US stores in March, I believe. Just got time for one final question. It comes from another previous guest of this live stream. Hello, good evening, Martin Watkins. It's lovely to hear from you. You've been mentioning technology, Mark, already. What Martin is asking is, how do you think financial innovation via the likes of the blockchain and artificial intelligence, AI technologies, are going to transform the index business?
I think they'll transform more than just the index business. I think digital assets are the future. But how long it takes before we really see digital assets in equity forms, I don't know. But digital assets are growing in popularity. It's not just cryptocurrencies, but all forms of digital assets. And in fact, exchanges around the world, SIX, SGX and others, are starting to form digital forms of bonds. But if you just think, digital assets allow you to create an investment from almost anything. And therefore, the opportunity is just enormous. So I do think digital assets will become a huge part of the future. I do think central governments will start to play a role in cryptocurrencies, and that will make them much more usable. But I do think this part of the market, it may take many years. and it may be just like China, and I may be talking far too early, but I do believe it will have a fundamental change in the way we invest and what we can invest in, and I think it's very exciting.
On that note, excitement, growth, a quarter century of incredible achievement from a 9-person startup to a business of over 1,000 people, an international indexing behemoth that you managed to create. And of course, you led the information services division of the London Stock Exchange Group itself after it decided to embrace the totality of the FTSE Index business a few years back under Xavier Rollet. Mark Makepeace, I really wish you every success with your book. I know it's already rushing towards being a financial bestseller in the UK and Europe. I've had readers of Exchange Invest Daily telling me how good it is all the way from Hong Kong and around the world. US viewers, you can manage to get it soon. It's going to be out in March. Of course, in the meantime, if you can't manage to get enough about the exchange business in your life, don't forget to check into Exchange Invest Daily, my daily newsletter, the only business daily digest with the unique PLY pith added in. Mark Makepeace, thank you very, very much for making this an absolutely fascinating return, our first live stream of 2021. And you know, it just leaves me to think of one thing. With lockdowns upon much of the world, ladies and gentlemen, children have been enjoying a whole new realm of digital gaming, particularly over the festive season just past. New games for 2021, I believe, include a remake of the Where's Wally franchise for parents who are wishing to encourage their offspring to become e-commerce entrepreneurs. Instead of Where's Wally, we've now got Where's Jack Ma? Where indeed in the world is the founder of Alibaba and related businesses such as Ant Financial, which was almost going to be the world's largest IPO, robbing Tadawul of their incredible benchmark achieved with the Saudi Aramco IPO just a few months before that. Where is Jack Ma, ladies and gentlemen? Seems to be a trend in all forms of search engine the world over. However, we're sitting here, it's a world of opportunity. Don't get COVID depressed, ladies and gentlemen. Thank you to all those of you saying those great words on LinkedIn. Mark Makepeace, thank you very much. Peter Aylan for your excellent question. Martin Watkins for your excellent question. Thanks to everybody who's been watching this show, and indeed to all those of you who are looking forward to catching up with this on Catch Up at some stage in the future. Don't forget, we're going to be here on Tuesdays at 7 p.m. in European time every week with another inspiring guest. Thank you very much once again, Mark Makepeace. My name is Patrick L. Young. I look forward to catching up with you on Exchange Invest Daily. In the meantime, we'll be back next Tuesday for another IPO VID livestream. And don't forget to order the book, FTSE, The Inside Story. Thank you, ladies and gentlemen, and good day, good evening, and good night, depending on where you are in the world today.